The IMF, or the International Monetary Fund, has sounded an alarm.
The International Monetary Fund has said that potential consequences from a US default could be higher interest rates and broader economic instability.
That's the prediction of the International Monetary Fund, which has slashed its forecast for global growth, saying
the IMF raises growth forecasts, but it says the UK is stuck with the G7's highest inflation.
Why is gold breaking records while banks feel the pressure? Is China's tech comeback shaking up global trade again? And what's behind the IMF's latest warning on rising global debt? Stay tuned. The biggest business stories of the week are unfolding right now, and you won't want to miss the final one. The red-hot rally in artificial intelligence stocks has triggered serious warnings from top global financial watchdogs, including the International Monetary Fund and the Bank of England, cautioning that a speculative bubble may be forming, while the massive investment wave in AI is driving record valuations for U.S. tech giants like NVIDIA and Broadcom. The IMF's recent report highlighted the risk of overstretched valuations in the tech sector, which could lead to a sudden, sharp correction that ripples across global markets. This apprehension is not merely theoretical. It reflects concern that the euphoria is outpacing realistic revenue growth, threatening the broader financial stability built on years of post-pandemic recovery. Investors are being advised to proceed with caution as central banks closely monitor the potential fallout from a sudden cooling of the AI gold rush. Global trade stability faced a significant new test this week as the U.S. and China exchanged fresh retaliatory measures, immediately impacting investor confidence and stock market volatility. The renewed escalation began after Washington's new tariff threats, which were swiftly met by China's Commerce Ministry sanctioning several subsidiaries of a major South Korean shipbuilder with deep ties to U.S. supply chains. This back and forth immediately fueled uncertainty, leading to the S&P 500 experiencing its steepest sell-off since April, before recovering later in the week as rhetoric softened. For American businesses, the ongoing trade spat signals prolonged uncertainty, forcing companies to reconsider their global supply chain strategies and brace for potentially higher import costs being passed directly to U.S. consumers. A sudden wave of concern swept through the U.S. financial sector this week after two regional lenders disclosed loan problems tied to potential fraud, compounding existing fears about the nation's credit market health. The anxiety was intensified by candid remarks from J.P. Morgan Chase CEO Jamie Dimon, who issued a stark warning about hidden issues within the broader banking system, famously referring to the possibility of a cockroach effect. This sent investors flocking to safer assets, pushing the price of gold to a new record high and causing Treasury yields to drop as markets priced in greater risk. The development highlights the financial system's vulnerability, urging regulators and the public to scrutinize lending practices beyond the major Wall Street institutions. The highly anticipated third-quarter earnings season launched, with several major American financial institutions reporting results that largely beat analyst expectations, offering a crucial lifeline to a volatile stock market. Firms like J.P. Morgan Chase, Bank of America, and Wells Fargo posted robust profits, primarily driven by higher interest income and resilient consumer spending, injecting a degree of optimism into an economy grappling with trade war fears and credit concerns. The strong performance of the banking giants is being interpreted as a key indicator of underlying U.S. economic strength, suggesting that corporate America can still navigate economic headwinds. The focus now shifts to how other sectors, particularly technology and retail, will fare as the earnings season continues to unfold. The International Monetary Fund's latest Global Financial Stability Report delivered a powerful, sobering assessment to global policymakers, warning that financial markets appear complacent despite rising geopolitical tensions, high government debt, and risks lurking in the shadow banking sector. The IMF specifically targeted the burgeoning and largely unregulated private credit market, cautioning that a potential wave of defaults in this sector could trigger global financial chaos, especially since many firms are funded through mainstream banks. This stark alert comes as global growth forecasts remain modest and uneven, urging central banks and fiscal policymakers to take immediate, credible action to prevent a systemic shock and restore long-term financial stability. After a volatile start to the week, Wall Street mounted a significant midweek rally, propelled by better-than-expected corporate earnings from both the U.S. technology and banking sectors. Strong profits and an optimistic outlook from firms like Bank of America, alongside gains in major semiconductor and AI-related stocks, helped the S&P 500 and the Nasdaq Composite post solid gains, effectively overpowering the lingering anxiety over U.S.-China trade friction. This market action underscores the deep split in investor sentiment, where corporate performance is heavily outweighing macroeconomic fears. The consistent positive momentum around AI investments, even amid global warnings, demonstrates a powerful underlying belief in the technological growth story. The U.S.
dollar experienced its worst week in months, dropping sharply against major global currencies, as Federal Reserve officials delivered a series of notably dovish comments on the outlook for interest rates.
The shift in sentiment was driven by signals that the Fed may be prepared to make larger or sooner rate cuts to stabilize the labor market, which is showing signs of weakness even as the government shutdown has delayed official economic data releases. This change in tone immediately impacted bond markets, with two-year Treasury yields hitting a three-year low. For multinational U.S. corporations, a weaker dollar could boost overseas sales and profits, offering a potential tailwind. But it also reflects deeper concerns about the nation's economic momentum. A major bright spot emerged in the European luxury market this week, which has direct relevance to U.S. luxury retail, as LVMH, the owner of Louis Vuitton and other top brands, saw its stocks soar by an impressive 14% on the back of stronger than expected demand from China. This unexpected surge reversed a recent downturn in the luxury sector, adding tens of billions of dollars to the market value of European luxury stocks. The strong Chinese consumer performance signals that high-end discretionary spending is rebounding in the world's second-largest economy, a crucial indicator for American brands that rely heavily on Asian markets for profit growth. The rally is seen as a sign of sector resilience, easing fears of a prolonged consumer pullback. The high-stakes drama surrounding the proposed merger of Paramount Global and Skydance Media captured global media attention this week, with reports suggesting the deal is moving forward despite resistance from some Paramount shareholders. The potential combination of these two American media giants is seen as a critical move in the ongoing consolidation of the U.S. entertainment landscape, aiming to create a stronger entity capable of competing with streaming behemoths. The reported elimination of thousands of U.S. jobs as part of a restructuring plan, however, underscores the tough financial decisions driving this massive corporate maneuver. The final outcome of this billion-dollar deal will significantly shape the future of Hollywood and the global content production market. Merger and acquisition activity showed signs of a robust revival this past week, highlighted by several high-value deals across the technology and telecommunications sectors, signaling renewed corporate confidence to deploy capital. Key announcements included a major American telecom company's acquisition of a smaller U.S. peer, along with a significant software and services merger, collectively totaling billions of dollars. This uptick in deal-making is a crucial bellwether for the health of the global economy, as large corporations are often hesitant to make massive strategic bets during periods of deep uncertainty. The renewed enthusiasm in M&A suggests that companies are looking past near-term volatility to position themselves for long-term growth and market dominance, particularly in fast-growing tech areas.